Good evening and welcome to Economics Unbound. Hello, Nana. I hope that you've been coping well and staying at home here in Studio 11 during the lockdown. Especially with such a few days left to go, we are on day 7 of South Africa's big lockdown. While South Africa continues to count the cost of the lockdown, we've seen ratings agency Moodys has downgraded South Africa's credit rating to junk status. Moodys is the last of the big 3 agencies to do so, after S&P, that's Standard & Poor's, Global and Fitch moved the ratings to below investment grade in 2017. Hello, Nana.
Good evening, Tans. The lockdown. I really can't get used to it, Tans. It's not easy staying at home, but I guess it's just a way of being safe with this coronavirus going around, and as the numbers climbed higher this week. But anyway, Tans, I'm a bit confused by junk, as in junk status. What do you mean?
Don't be silly, Nana. Remember, in economic terms, well, it actually means South Africa's sovereign credit rating has been downgraded to junk status. Most of us know that this is a bad thing with serious consequences economically, but we don't exactly know why, many of us. So today we'll be the explainers of what exactly that means. A downgrade to junk status means Moody's is saying that the likelihood of our sovereign debt that is denominated in foreign currency being repaid is very low. In other words, the likelihood of us defaulting on our foreign payments or our foreign debt holders is high. The government borrows money almost monthly to help pay its bills. Most government debt is in rand. Only about 15% is in foreign currency, Nana.
Okay, Tans, I understand. Lol. Just to add for our viewers, credit ratings are a measure of the credit worthiness of a country's government, meaning that they show how likely the government is to pay back borrowed money. These ratings are important because they influence the cost of borrowing. You heard the president's reaction to the Moody's downgrade on Monday night. He said this will be tough as it would hike upwards the cost of borrowing. If a country is more likely to default, lenders will charge a higher interest rate to compensate for the greater risk, as they would if the borrower were an individual. But let us just listen to what President Cyril Ramaphosa had to say.
As the country went into lockdown, we received the sad news that the rating agency Moodys had downgraded South Africa to a sub-investment grade. This will significantly increase the cost of borrowing to fund government spending and will have a negative impact on the economy. This development will not diminish in any way our response to the coronavirus pandemic. We are pushing ahead to implement the necessary health interventions and economic and social measures to contain the spread of the disease and alleviate its effects on our people. Within the constraints of the current crisis, we remain committed to implementing structural economic reforms to address weak economic growth, constrained public finances, and struggling state-owned enterprises. We're working together with our social partners to identify further measures we can take to limit the damage on our economy and to ensure that as we emerge from this pandemic, we set our economy on a clear path of growth.
Now let's just listen to what some economists had to say recently.
This downgrade by Moody's was expected. It's been long coming. I think it just means that Moody's has run out of reasons to protect our sovereign rating. And it means that Moody's has decided that they want to join the rest of the ratings agencies such as Fitch and S&P in saying that South Africa's economy needs a lot of work done, and so it must be done urgently. And I think that from a perception perspective, it has already painted South Africa as a country that some people might not want to come and invest here because they worry that their returns might be at risk. And if the returns are at risk, people do not want to invest in that particular country or company, as it were. And unfortunately, what it also means is that the banks and other financial institutions are now under a lot of pressure as well, because they've already been downgraded in line with the sovereign rating. No company can be rated higher than its country's rating. So any company operating in South Africa that borrows money internationally now will have to pay more in interest. And obviously that spells potentially more job losses and companies rationalizing their expenditure, reducing their project sizes, or postponing their investment in the economy. And that way we can see just how much more pressure the country will come under. We can expect that there will be job losses if the government doesn't stand up and create a solid reform plan, a solid economic strategy that will get South Africa to a position where it can start being re-rated.
The Moody's downgrade came at the worst possible moment for South Africa in the midst of a coronavirus lockdown. As a result of the downgrade by Moody's, borrowing rates in South Africa will increase sharply, and we've already seen a drop in the exchange rate of the rand to below 18 rands to the US dollar. We will see in weeks to come what the full impact of the downgrade is, and we have to be wary of the risk that other rating agencies can downgrade South Africa even deeper into non-investment grade or so-called junk status, which will lead to bigger financial difficulty for the country.
So what can be expected in the aftermath of achieving full-blown junk status? Well, first and foremost, we saw a drop in the value of the rand. There was a further depreciation in the value of the currency on top of the weakness that set in due to the virus pandemic and the flight to safe haven currencies, notably the dollar. Usually, in South Africa's case, rand depreciation causes both export and import values to rise if trade volumes do not change materially. Consequently, one would not expect the current account on the balance of payments to be hugely affected. We still import essentials such as capital goods and oil, while we are paid in dollars for our commodities. However, with the current pandemic, these dynamics changed somewhat, causing, for example, the gold price to rise and oil prices to plummet. This may give rise to the trade balance swinging into a surplus, albeit perhaps temporarily. The major negative effect of the ratings downgrade will be on the availability and cost of foreign capital. South Africa's domestic savings pool is not big enough to fund all capital expenditure projects, especially those related to building, construction, infrastructure, and development finance.
Economists say the junk rating by Moody's need not have further impact on the country's economy, as a lot of damage has already been done, and the effects of the downgrade have already been priced into our economic forecasts and models. Moody's on Friday evening stripped South Africa of its investment grading, lowering its bond grading to junk status. Moody's cited constraints on the government's finances and a weak economy as reasons for the downgrade.
The African economy is facing an uphill battle made worse by the impact of the coronavirus. The economy is expected to contract by 0.2% this year or more. To make matters worse, Moody's ratings agency downgraded the sovereign to sub-investment grade, citing weak economic growth, further fiscal deterioration, and slow progress on structural economic reforms. Now, government has scrambled to put in place measures to try and cushion the already limping economy from the impact posed by the coronavirus. Given our budget deficit and the need to borrow to supplement the low revenue, the sub-investment grade status will significantly increase the cost of borrowing. President Cyril Ramaphosa says government remains committed to implementing the structural economic changes and reforms to turn around the economy.
We are pushing ahead to implement the necessary health interventions and economic and social measures to contain the spread of the disease and alleviate its effects on our people. Within the constraints of the current crisis, we remain committed to implementing structural economic reforms to address weak economic growth, constrained public finances, and struggling state-owned enterprises. We're working together with our social partners to identify further measures we can take to limit the damage on our economy and to ensure that as we emerge from this pandemic, we set our economy on a clear path of growth.
Welcome back to Economics Unbound. And now on the line, we have FNB economist Siphamandla Mkhwanazi. Now, Siphamandla, what's your opinion of Moody's decision to downgrade us? A colleague of yours said that they had actually run out of reasons to protect our sovereign credit rating.
Yes, hi Tandek, and good evening to your listeners. Yes, the question of the downgrade has been with us for quite some time now. Moody specifically has been rather kind to South Africa. If you look at other credit rating agencies, S&P and Fitch, they pulled the trigger about 2-3 years ago, and they based that decision on the very same fundamentals that Moody's based its decisions over the past 2 years on. Given the fact that the outlook on South African economic outlook, given the outlook on South African economic growth, I do believe that I agree that Moody's actually ran out of reasons not to pull the trigger. In fact, this could have happened a year ago already. But we are grateful, obviously, that they delayed that decision for as much as possible, given the impact that it has on South Africa as a whole.
And what are the highlights for you? What stood out for you in their ratings note?
They were quite honest in their outlook. It was quite scathing, actually, and it was a build-up from the October statement, which mentioned specifically that should South Africa continue on the current debt trajectory, they were going to pull the trigger, and they did exactly that. What was startling for me is their outlook on growth and the language they used in the statement. They mentioned some such things as chronically low economic growth, which just means that we are unlikely to escape this low growth trajectory unless, obviously, there is some structural shift in the economy itself. So a structural shift would come from policy decisions as opposed to short-term variables such as the interest rate, which is part of what has kept us afloat for some time. So it was a clear message that should we not get our books in order, there is a risk that we are facing even more downgrades. This is not the end of it, so we could still go a bit. We could get further downgraded, and that just makes it even more difficult to regain your investment grade once you get more downgrades after a sub-investment downgrade.
Now, Siphamandla, anything new about their recommendations, or is it just all much of a muchness?
Look, I mean, they have been saying this for the past 2 years. The message has been consistent. We know what our problems are. I think that we're going to have to find that will to go through with the recommendations that have been tabled. These are not new. Other institutions such as the World Bank, such as IMF, have consistently conveyed the same message to South Africa. I think now it's only a matter of a political will to go through with those recommendations.
Now, ratings agencies, and especially Moody's, go through a certain process to arrive at their decisions and to make those announcements. Now, they spend a lot of time speaking to our economic leaders and our economic managers, and they spend some time in Treasury, and so they have a degree of intimacy with our challenges and our problems. What can you tell South Africans goes on in those meetings?
Look, they tend to be quite honest and frank discussions. It's detailed. It's a detailed exercise on the strength of the country's ability to repay its debt. So they look at the strength of our balance sheet, they look at the level of our debt, and our ability to generate income or generate revenue to be able to repay that kind of debt. And there's a session on recommendations on policy directives that could lead us to a higher growth trajectory. Now, the South African case is quite unique in that we still, even after 25 years, we are still dealing with those legacy issues that were structural, that were institutional, and that will need institutional and structural or policy shifts in order to be able to reverse the impact on. And then these rating agents are quite aware of those issues, and I think part of the reason why Moodys has been rather lenient on South Africa, I think it comes with the recognition that some of our problems are unique, and you will not find them anywhere else in the world. But positively, they do give policy recommendations, not necessarily Moodys, but other institutions that have that are interested in our ratings. They do give recommendations, and those are known, as I've already mentioned. But to answer your question shortly, those they tend to be quite frank discussions. They hold no punches really in looking at the strength of our balance sheet.
Ideologically, we've been on the same kind of economic policy trajectory since democracy, really. And this path has delivered low growth. And Moodys seems to suggest a continuation along this path. What is it that we can do differently and innovate around as a people?
Right. So to give us a bit of a background, you are correct in that we have sort of been in the same policy trajectory since democracy. What helped us for a number of years is the fact that we were a new democracy. We presented hope to the world. We were this new kid on the block, and everyone was just interested in South Africa. Everyone wanted to come to South Africa and invest. We had hopes of, we promised a growing middle class. We promised very low electricity or energy prices. Now, all of that is now gone. And we also were lifted by global activity at the time. Now, since we have since decoupled from that global lift, in other words, with global economies improving, we haven't seen in South Africa domestically, we haven't seen as much an improvement due to that economic growth. So we have decoupled, which means then we are going to have to find growth within. We have to find growth will have to be generated within South Africa. We no longer have to. We no longer have the benefit of relying on global economy to lift us up. Now, things that these agencies recommend range from the releasing of the spectrum, which is one of the easiest or the quickest thing one can do. Things such as changing the visa regimes so that we are able to import scarce skill. Things such as opening up the industry in energy generation so that there is more competition, which in the long run will drive prices down and give consumers a bit of alternatives, which in effect will drive prices down. So it's such things. Some are more long-term, such as educational outcomes and the like, and some are more short-term. To group these recommendations, there are those that are confidence boosting, which will give you a boost in the short term, and there are those that will give you a boost in the longer term, such as education and all of that. So there is something we can do right now that can boost us, and there are things that we need to do on a longer term basis.
So, Sipamadla, how does this ratings downgrade affect the ordinary South African?
Okay. So the starting point is that for the country, it becomes more expensive to raise capital or to raise debt. So the rates that we pay on our debt is much higher. So if we pay much higher rates on the debt, it means because we are unable to generate revenues due to low economic growth, it means that we're going to have to take away from other social programs such as the building of schools, such as social grants, and repay this debt that we owe. So that's the first thing. The second thing is that usually when you get downgraded, your currency depreciates, which is what we have seen. And usually with the currency depreciation, you tend to see domestic prices go up. So the price of bread will automatically go up because the cost of importing wheat that goes into the making of the bread, because South Africa has to import wheat, has gone up. So therefore the price of bread will then also go up. So that's the mechanism that the men on the street get affected by all of this. It's all through prices. And the other parts are that usually, not always, usually taxes do go up in an attempt, which is the government's attempt to raise more revenues. But we do also find cases where taxes actually go down, with government attempting to stimulate their economy. So that one is a bit ambiguous. But overall, usually you get higher inflation, which means higher domestic prices, the price of bread. It means also that government has to divert the spending away from social programs to paying the debt, which then affects the poor, such as the old age and the disabled.
So, Siphamandla, that was a great explanation of exactly how the ordinary citizen would be affected by the downgrade. So, Nana, after that great conversation, I'd like to know what you think. A penny for your thoughts.
So, to be clear, the three credit rating agencies, Standard & Poor's, Moody's, and Fitch, do not measure the health of the local economy. Rather, they assess the government's ability to honor debt commitments. These measurements take certain economic indicators into account and are themselves seen as indications of a country's economic prospects. Let's listen more to my producer, Prudence Makubalo, on how it affects the economy.
With the downgrade, the government has to pay more in debt servicing costs, meaning that it will have to less spend on social initiatives and infrastructure. In order to plug the funding gap, government will have to increase revenue through higher taxes. But the effects of junk status don't end at borrowing. A downgrade will likely also cause the rand to depreciate, which would make imports like oil more expensive. When inflation rises above a designated target range, the South African Reserve Bank puts the repo rate up, which increases the cost of vehicle loans, mortgages, and other long-term loans. When lenders such as banks see a greater risk in borrowers defaulting, they increase premiums to compensate for the greater perceived risk. South Africans will also find it harder to qualify for new loans, and when they do secure credit, it will be more expensive. There's no denying that we face difficult times ahead to survive during higher inflation and rocketing interest rates. Everyone will have to make changes. It's important to remember that credit ratings are simply barometers for investors regarding how well a country is doing financially. The Moody's downgrade last Friday is therefore no more than a confirmation of what we already know, which is the local economy is not functioning optimally. Key going forward will be the ability of President Cyril Ramaphosa's government to act with political unity to reform South Africa's economy. On the upside, the 2020 budget addressed many of the challenges that need to be resolved, including reducing expenditure, reducing the tax burden on the country's citizenry and business, and more room for private sector to be involved in aspects of the economy that have to date been the sole preserve of state-owned enterprises. Prudence Makubalo, SABC News, Johannesburg.
Thank you, Prudy. On Skype, we have Intellidex analyst Peter Attard Montalto, and he's joining us from London. And welcome, Peter. Great to have you back on Economics Unbound.
Thanks very much.
Now, the effects of the downgrade have already been felt. Government tried to move a bond on the markets, and there were no takers.
So we've seen basically very distressed markets trading at the moment where people want higher interest rates. The peak was just over 13% that the investors wanted to have to hold a South African bond. But since then, the yields have come back lower towards 11% or just above. And that's been helped in particular by action the central bank has taken. They have come into the market and started buying a small amount of debt. They're not buying directly from the government, they're buying from other investors, and that's helped to bring the yields down a little bit. But basically, the whole bond market, the yield, is a sign of the stress and the worry investors have around the economic outlook in South Africa.
Now, our central bank is normally very reluctant to intervene directly in the market. What do you think of their actions recently?
So exactly, they took us by surprise a little bit. We were saying very strongly in the last couple of weeks that there was a lot of stress coming in the bond market. We were obviously thinking they were very conservative and wondering if they would take further action. They've done so in sort of a minimal way. There's a lot more they can do and probably will have to do as the coronavirus crisis gets worse, as we see a very large drop in tax revenue coming, a very large step up in the amount of new bonds that the government's going to have to issue in this new tax year that started this week. So we're probably going to have to see the SARB taking further steps. So it's been okay for now, but certainly I think markets and investors are waiting for a lot more action to come.
In a little more detail, what do you think of what the SARB has done so far, reducing interest rates as well as intervening directly in the bond market?
So the coronavirus crisis in South Africa basically is creating a significant problem around the ability for SMMEs and for larger corporates and individuals to repay their debt. And this basically is causing some degree of stress in the banking system, which means that interest rate cuts, whilst they help a little bit, are not really the key measure here. So whilst it's very welcome that the SARB has reduced interest rates, they'll probably reduce interest rates by another 75 basis points. It's really these other measures they're taking, the sort of complex relaxing of some bank regulatory rules that's now in process this week that will help the banking sector, the bond buying that they've started, and some further measures that they can take to help banks provide as much forbearance, as much support for people struggling to pay debt. That's really much more important here than cuts in the interest rate.
Well, there's a bit of a debate here in South Africa as to whether what the bank did amounted to quantitative easing light, as you have Coke Light, or not.
Exactly, or Coke Zero. This is sort of not QE. We're calling this not QE. So the SARB is getting upset if you call it QE. We should remember that there is a political issue around QE. A number of politicians in the last 2 years were talking about QE. And coming in, the central bank buying bonds. The central bank is saying it's not QE because we're not at the lower bound of interest rates. We're not at zero interest rates. The reality is the market is treating this like QE. The central bank is in the market buying bonds. And so if it quacks like QE, if it tastes like Coke Zero, it probably is.
So what do you think of the room that they've developed over time to lower interest rates even further?
So there is some room here, given what we call very low FX pass-through. That means that the man on the street feels a currency depreciation in the basket of goods they buy, but only a very limited extent. The fact the oil price has dropped very significantly in the last 2 months, now down to $20 a barrel at its base, now coming up a little bit. All of that is helping provide some room to cut interest rates. But really, I think the man on the street is going to feel it much more if the banks are able to offer them support with their debt repayments, offer debt holidays, etc. And so they're the more complex regulatory steps we're waiting the SARB to take in the next couple of weeks.
Now, you mentioned politics. Why do you think our Reserve Bank has been traditionally quite conservative, as you put it?
So in this very low growth environment that we've had in recent years and coming out of the previous administration, the lack of structural reforms that we've seen, the fact that growth has been negative in per capita terms, it means that growth is less than population growth of the country. All of this basically puts pressure on quick, easy wins. And so cuts in the interest rates were viewed in the past couple of years as an easy way out. Now, the SARB wanted to resist that because they knew that temporary interest rate cuts would only have a temporary impact on growth. And so they've been very reluctant. But these aren't normal times now. These are stress times where the economy needs emergency support, where the banking system needs support and banks' customers need support. And hence they're taking this less conservative action. But they're still doing it in a very slow, step-by-step manner. They're still not wanting to buy bonds directly from the government. They're still not wanting to cut interest rates to zero. So some of that conservatism is left, but we should remember that we're in a deep crisis, the start of a very deep economic crisis with coronavirus, and hence the shift in mindset from this risk aversion they had before about basically giving the free lunch to the government and sort of giving the government incentive not to do the very challenging structural reforms that are really necessary in the economy.
Now let's talk about the UK. Mark Carney, the head of the Bank of England, has been asking banks to conserve capital. And we saw them move in the UK to cancel all dividends and to ban or get rid of share buybacks and so on. Do you think that we will get to that stage here? Why does the banking sector need some kind of complex cushioning at a time like this?
So the South African banks are not necessarily in the same situation. They weren't making as much money in the last year, given the weak economic outlook, as the UK banks were. So this isn't as much of an issue in South Africa. But there are going to be certainly a lot of requests coming out from the central bank to banks about how they manage their balance sheet. A lot of that is this rule easing that I mentioned. So it's now easier for banks to absorb some of the losses that are coming down the pipe very quickly from coronavirus. A lot of the SMMEs, for instance, who are now having trouble repaying their debts as a result of the lockdown. The banks basically, because they have an easier set of rules to follow, that can basically be passed on to those customers and they can be allowed some degree of flexibility. Now that's all quite marginal. We're waiting for particularly a next big step in this would be basically new lending for the central bank and the government to jointly help banks lend new money into SMMEs, into companies having cash flow problems, who are having problems paying their staff during the lockdown. Those sorts of discussions are ongoing, but it's that sort of issue, helping banks actually lend new money, new working capital, is really where you're going to get the largest bang for your buck in terms of support into the economy during this crisis.
Now, Peter, if you could just take a looking glass and look into the future of banks and look at the future activities and actions of the SARB, what do you see? Can you paint a picture of that?
So I think as the coronavirus crisis basically worsens, as we see the case numbers and the death rate slowly climb, as we see the number of bank bond impairments, that's people, customers having problems repaying their debt, I think the SARB will steadily take step-by-step additional measures. I think Treasury will take step-by-step additional measures. Slowly, reluctantly, that conservatism will still be there. But I think we will get to a point where a lot more support is provided into the economy. We've seen the government come out with some very good schemes, such as from the Department of Small Business Development, such as the UIF fund to support workers. But these things really lack capacity and size because of the fiscal situation. So it's really going to be the banking sector that ultimately is providing that support into the economy. I think we get there eventually. It will take a while to get there. But I think as this crisis develops, that is the end point that we see out there.
Well, thank you very much for joining us this evening. That was Peter Atalt-Montalto joining us from Intellidex in London. Welcome back to Economics Unbound. Ratings agency Moody says its decision to downgrade several state enterprises in the country to sub-investment grade reflects the weakening capacity of our government to support these institutions in case of need. Now, Moody's downgraded the Airports Company South Africa, the Industrial Development Corporation, the Development Bank of South Africa, and the Land Bank. The agency downgraded South Africa's sovereign credit rating to sub-investment grade or junk status. With regards to AXA, Moody says the airport and aviation sector is among the most significantly affected by the coronavirus, given its exposure to travel restrictions and sensitivity to consumer demand and sentiment. Now, analysts say it's time for government to adopt ultra-aggressive economic policies following a downgrade by Moody's, and that's a downgrade of our sovereign credit rating. Many say it's not surprising that Moody's has downgraded South Africa to sub-investment grade or junk status. All three major ratings agencies have now downgraded South Africa to junk. Moody's attributed the latest downgrade to structurally weak growth and constrained capacity to stimulate the economy, as well as a rise in government debt over the medium term. Now, on the line, I have analyst Saveshan Pillay to talk to us. Hi, Saveshan.
Hi, Thandeka. How are you doing?
I'm well, thank you. Thanks for joining us.
No problem at all.
What do you think about this whole Moody's thing? Are we making more of it than ought to be made of it? I mean, it had already been priced in, it was expected, and the fallout was expected.
Thandeka, yes, I'd say you're correct. So markets obviously priced in this downgrade in the lead up to it. So, I mean, if you look at it in March, for example, there was already a sell-off of South African government bonds. So foreign investors decreased their holdings from around 37% to down to around 33, 34%. So, I mean, that forced sell-off was, market participants did see it coming. They did see the potential downgrade coming through. But generally what happens is that, so I won't say that it's a bit overhyped. I'd say that the context of the current market, so if you factor in the coronavirus, this actually couldn't have come at a worse time for South Africa. So there's obviously much less liquidity in markets, and you've now got the downgrade which comes through, which obviously adds more strain to that. So I'd say that, look, in the current context of it, it's the worst time that this could possibly happen to South Africa. I personally was hoping that they would probably hold on until later in the year. But I think they were obviously also aware of the numbers from Treasury, because they obviously liaise with Treasury. So the numbers that came out yesterday, the revenue numbers were obviously significantly, there was a significant shortfall. So I think that shortfall was actually larger than the shortfall within the last financial crisis. So that's the extent of it. So I mean, it was significant, and they obviously see that continued fiscal deterioration, which is just going to get worse with this coronavirus, a decrease in economic growth, and that's probably the reasons why they acted. So look, in terms of the effects going forward, it's obviously going to be quite significant. A lot of it is priced in to the market, but I mean, there would be that passive selling that would take place at the end of next month. So next month is when we exit the World Government Bond Index. So hopefully the reprieve that we would have would obviously come through from the South African Reserve Bank in terms of the asset purchase program. So what would happen in that instance is that they would intervene in the secondary market, and the secondary market would be a proxy for the primary market bids. So that might provide a bit of support to government bond yields and the cost of debt to South Africa, depending on the quantum that the South African Reserve Bank engages in. But I mean, there would be that passive selling which would take place at the end.
Now, Savashan, they were very coy about mentioning the quantum of the intervention. That's a SARB. They didn't want to say how much they're spending out there.
That's correct.
Why?
Correct. I think that, look, if the market perceives it to be a full-blown level of quantitative easing, similar to what takes place in offshore market in developed countries, then that obviously would have a significant negative effect on the South African rand. So you've obviously got to understand that quantitative easing takes place generally with reserve currencies, so they aren't really affected by an increase in supply of money in the economy, because there's a much higher demand. So I mean, I think that the Reserve Bank is being a bit coy about it, just to not paint the picture that this actually is going to be a large-scale bond repurchase program, and thereby including a lot of stimulus into the economy and a large money supply. So I think to preserve the currency or to maintain the currency at its current levels, they obviously are being a bit coy about it. From that perspective.
So you're basically saying that they're a bit image conscious. So let's talk about the optics politically. What does this mean?
So I mean, look, in terms of the quantitative easing program, it was something that obviously the people within the ANC have obviously indicated that at previous, I think it was a previous ANC endeavor where they brought it up, that they obviously wanted to introduce this measure of quantitative easing. But I mean, the South African Reserve Bank has obviously pointed out that these interventions will not be in the primary market, meaning that they won't be purchasing government bonds directly from the government to obviously finance the fiscal deficit. It'll be done through the secondary market. So I mean, from a political perspective, it'll probably be a win that there is some sort of intervention by the South African Reserve Bank, because a lot of political actors indicated that the South African Reserve Bank's intervention over the last few years has not been significant enough to stimulate economic growth. So I mean, from that perspective, there'd probably be a win, as there is more action from the Central Reserve Bank from that perspective.
Did they act under pressure?
Look, the thing is that we are actually in a crisis situation, and I mean, if you look at the options available to South Africa, so from a fiscal agility perspective, there isn't much room from a fiscal perspective to stimulate the economy, because we know fiscal deficit is obviously quite high. So I mean, the Central Reserve Bank does have a bit more room to act, just based on the way in which they've contained inflation over the last few years. But I mean, so I'd say that, look, if you look at liquidity in markets at the moment, it's something that is needed, because there's a lot of, so for example, the Unemployment Insurance Fund needed to liquidate around 30 billion, and that 30 billion was housed in South African government bonds. So if they want to liquidate that, there has to be a buyer. And in the current market conditions, where there being limited buyers, the South African Reserve Bank stepping in the way in which they have indicated that they would, presents itself as a buyer to that. If you look at asset management companies, clients, obviously a lot of redemptions. The fixed income portion, which is held in South African government bonds, needs to be liquidated. There then needs to be a purchaser. So again, the South African Reserve Bank will come in there. So I'd say from that perspective, it's actually a good step that they've taken as a short-term measure. I don't think it would be a long-term measure, but at least we have the benefit of having the room to be able to do that. So from that perspective, I'd say it's in the context of the South African downgrade. Look, it's gonna, as I mentioned, it's obviously gonna assist us. Hopefully, it would provide a bit of reprieve to bond yields, because that passive selling would still obviously continue. So I'd say from that perspective, it's welcomed. I'd say from that perspective.
Now, Savashan, the IMF said that countries, whether they've got fiscal room or not, should try to move and reallocate their budgets through supplementary budgets and so on towards health care infrastructure. And we haven't seen much of that happening in South Africa. But also they said that they have a fund available. And we have heard the finance ministry speaking about possibly tapping into the IMF fund for to increase our firepower in terms of our ability to respond to the challenges of the coronavirus. Do you think this downgrade will affect our ability to attain those funds?
Look, I don't think it will. I think that the IMF would always be there for South Africa to turn to. I mean, look, in terms of obviously approaching the IMF in the first place, I think the Minister of Finance came out this week and indicated that they would be willing to obviously engage with the IMF and the World Bank on those terms. But I mean, in terms of engaging with the IMF due to the lack of funds within the country in terms of fiscal deterioration, then I mean, countries generally approach the IMF on that level when there's a balance of payments problem, when there's less liquidity. So, for example, to finance our fiscal deficit that we run.
But that wouldn't be the case here. It would be a case of tapping into a fund made available for responses to the coronavirus.
That's correct. That's correct. So,
now,
I mean, look, it's... Yes.
Now, the BRICS Bank is speaking about making funds available too.
Beg your pardon, can you repeat that?
The BRICS Bank is speaking about making funds available too.
Yes. And I mean, look, that's welcomed as well. And I think that South Africa might be in a more comfortable position to obviously borrow from the BRICS Bank, because we obviously are we were one of the founding members of the BRICS Bank, and we're part of the BRICS group. So I mean, there's a common economic benefit to all of the countries that are involved with the BRICS. So I mean, South Africa might be more comfortable and might potentially get better terms from the BRICS Bank than they would from the IMF. So just remember that even if we do approach the IMF within that fund, it's funds that we're going to borrow and we're going to have to obviously repay. So government would obviously have to weigh up the two options and obviously look at which would be the most feasible for the government to pursue going forward. But in terms of the downgrade, it's probably not really going to affect that in terms of access to those funds, because those funds would obviously be available in a crisis situation such as this.
Savashan Pillay, thank you very much for joining us tonight. Thanks for watching us, dear viewer. Thanks for joining us today as we engaged on the issue of Moody's and the downgrades. Till next time, goodbye.